Try one more approach, Charlie, before you can tell us what we should be doing. And that is, you have been on the board of some very successful financial institutions, and you have certainly, been in an advisory capacity for the Yale Endowment, which has one of the best track records of any endowment in the country.
Absolutely.
And they're active managers. So why can't, we participate in something like that? Are there other firms that that have mutual funds that we can do as well, or at least better than the markets, as the Yale Endowment has done?
No. I mean, it's very disappointing to many people, but
right.
The truth of the matter is you can do better than other investors by indexing. You'll do much better than other investors if, instead of worrying about individual mutual funds or individual stocks, you think carefully about who are you and what's your reality. Do you have enough income so you're saving money? Are you young enough so that you can think in terms of 50 years? Are you able to learn enough about investing so that the ups and downs of the market don't matter and they don't disrupt you and cause you to get nervous and tensed up? Are you able to avoid, after a bad market that's been bad for a year or two and everybody's writing about how bad it's going to get, are you able to maintain calm and stay long-term knowing that these things do happen fairly often and that if you don't react, you're fine?
Of course,
all those things are really important.
Right.
And then how much time are you willing to spend on thinking about your family and yourself and what you're trying to do? And if you just could focus on those things, you can do yourself a world of good. I mean, really a major advantage.
But for our audience that don't have the luxury of a 60-year time horizon or whatever of investing, and
wait a minute. I look at myself, for example. You say, Charlie, you were in your late 70s. You don't have 20 years. Okay, so I don't have 20 years. What am I doing making long-term investing? First of all, I would like to be sure that I've provided for my beloved wife, wonderful person, something I feel very serious about. I have children, and
right.
Son of a gun, they have children. And the idea of my children and their children being able to get a good education appeals to me, and I think that's a nice thing.
But for retirees, for instance, in our audience, who basically want to make sure that they are able to support themselves in retirement
let's focus on that group.
Yes. So focusing on that group, many of them hold mutual funds, and many of them probably hold several mutual funds. Should they be switching to index funds at this point? I mean, what's your advice?
Well, they shouldn't switch to index funds unless they would like to reduce the cost of activity, and they would like to increase the rate of return that they're enjoying.
Right.
And they'd like to stop being nervous about the market and individual stocks. And the investment organization they're working with now might get acquired by some gigantic insurance company, as often has happened over the last 25 years. If they want any of those things, but if they like to pay high cost, and if they like to be worried about individual stocks or individual managers, and all of that sort of stuff, and they don't mind coming in behind the market averages on a regular basis, and sometimes getting really schnockered, that'd be fine. But I haven't met those people yet.
So you're saying that basically all of us, no matter what stage of life, if we're investing in the market, we should be in index funds.
Let's say all of us.
Right.
I still think that Warren Buffett should not.
Right.
I still think David Swensen at Yale should not. And there are half a dozen other endowments that I feel the same way.
Right.
Certainly there are people who are absolutely marvelous at this kind of work who can, because of their experience, history, and their knowledge of individual people and their relationships, they can do slightly better. But they don't do a lot better. They do slightly better.
Choosing your index funds, what's your recommendation there? Because there are a lot more index funds out there. I mean, I know you've been a long-term advocate of broad diversification. So, Vanguard, you used to be on the board of Vanguard. They certainly have some funds that are total stock market index funds. Is it a one-stop shopping decision?
Pretty close, but let's take it seriously and go through the drill. Number one, if you're at all sort of, I just want to do some, the S&P 500 or the equivalent, a broad, diversified index fund. Focus on low cost and be sure it comes from a well-known, experienced provider of index
Right.
funds. And there's several. BlackRock does it, State Street does it, Vanguard,
Right, Vanguard does it, right.
So, if you wanted to be a little bit more up to speed, rational, doing the right sort of thing, you should probably think in terms of more diversification, and you should probably have about half in US stocks and about half